screen again. Okay. All right. We're getting ready to do personal finance, chapter 16, static problems. So this is all about mutual funds. Mutual funds tend to be a grouping of various investments so that they're not so risky. If one goes bad, maybe some of the others will do fine. So mutual funds are made for more of what I call your everyday investor. A lot of mutual funds are invested in with retirement accounts and 401ks and all that kind of stuff. But you can treat mutual funds pretty similar to buying stocks. Okay. So remember when we bought stocks, we bought so many shares at a price, right? So this is kind of how I want you to think of mutual funds too. All right, so let's get started. We have, okay, just a second. 15 questions. All right, so let's get started. If the New York Equity Growth Fund, if it has total assets of 1,540,000 and 14 million in liabilities, and the number of mutual shares they have is 40 million, then what is the net asset value of each share? So that word net means something gets subtracted. What will get subtracted is the liabilities from the asset. So the good thing about this is these are all in millions, right? So you can just knock off the million and treat those all the same number, right? So here's how it's going to look. We're all doing this problem, sorry. In my financial accounting class, a lot of times we were doing algorithm problems all the time. So, all right, so here's what we have. We have 1,540,000. We're going to subtract the liabilities of 14. And then we're going to divide by the 40 million shares. And then we're going to get a price. Okay, we're going to get a price of each of these mutual shares. Okay, so let me put this in and subtract the 14 million and then divide by 40 million and hit enter. All right, so if you are wanting to buy a share of this mutual fund, then to know the value of the mutual fund. There you go, the value of it. Okay, because it's representing that fund, and funds have assets and liabilities. And then you divide by how many shares are there. And then, so the higher this is, probably the better, right? And once again, you're getting used to that word net. Something gets subtracted when you see that word net. Okay, let me try to test it now. See if we're all right. And we want to make sure to put that in 2 decimal places because that's how money works, right? Money works with 2 decimal places. Okay, so I am putting that back in there, assuming that it's still the same. Okay, $38.15 a share. Okay. Let's go on to number 2. Number 2 is similar. Okay. What is the net asset value of a share of this Hampshire small cap fund? You say, what does all that mean? A fund gets a name. Okay. I'm sure you've heard of a fund manager. This is the kind of funds that get managed. So we've got 700 million in assets, 8 million in liabilities, and a total number of shares of 25 million. Since they're all in millions, we can do the same thing we just did before. Just put in the numbers. So we've got 760 million minus 8 million, or minus 8 million in liabilities, divided by 25 million shares. 25 million shares. Okay, so 760 minus 8, divided by 25 is $30.80. $30.80. That's how you figure the net asset value of that mutual share. Okay. All right, onward we go. Okay, now another thing about this chapter is it tells you quite a bit more about the fees and the commissions that brokerages charge, because they have to make money too. Okay, when you call a financial advisor and you say, I want to change this or that, or I want to start an account with your firm, you're going to have to pay something. Somebody is going to have to pay something somewhere, or they wouldn't be able to stay in business. So this one is a commission, right? A commission is the cost of making a purchase or a sale, or the fund itself has a charge, right? A fund manager. A fund manager is always looking at the fund going, I need to sell these, I need to buy these, I need to sell these, I need to buy these, and constantly trying to rebalance it. And takes a lot of knowledge, takes a lot of work, and that's people's money that is kind of relying on you to make good choices, like you have a crystal ball or something. So anyway, the commission. So Candace is investing $15,000 into an Invesco active allocation fund. The fund charges a 5.5% commission when shares are purchased. So the amount of the purchase, you take the amount of purchase, which this one is 15,000. We take it times 5.5%, and there is the charge. Okay, there's the amount of the commission for that purchase. So 15,000 times 5.5 commission. And okay, it looks like 5.5. I already have it in there. So this is $825. Okay. And it's either going to be added on top of, no, it'll just be pulled out of the fund. So it'll just be pulled out of the fund, but hopefully the fund will start making profit, or you'll start seeing gains, and that fee will just get absorbed, right? Absorbed in the fees. Okay, but please know that those management fees are happening. Okay, you see investment commercials sometimes on TV. There's one called Fisher Investments, and they always say, we get paid more when you do better. Right? That kind of thing. So that's kind of how it works sometimes. Okay. But this is just a straight commission for making a purchase. All right. Ned is investing $18,750 in a Washington mutual fund. The fund charges 5.75% when shares are purchased. Calculate the amount of that commission that Ned must pay. So once again, put in the amount of the purchase, and it's 5.75. And then the commission for that particular purchase is $1,078.13. So you just got to think about how to multiply with a percentage, right? Multiply with a percentage. Any questions on the first four? Okay, good deal. Onward we go. Number 5. Okay. All right. This says, now some funds, you start your account just like those last two problems did. One started an account for 15,000, the other one did 18,750. Some funds, before once you start them, there's paperwork involved. Quite a bit of paperwork. You've established your account with the fund manager or whatever. And then if you go to try to pull money out, there is what they call a withdrawal fee. If you try to withdraw too quickly, like within the first year of your account to the 5th year of the account, they're gonna ding you a little bit. Okay, you say, what? Yes, because they would really rather that you leave your money in there, right? Because you're trying to grow your money in the first place. So these withdrawal fees are meant to discourage you from pulling money out of there just because you want, just for any whim that comes to your mind, all right? But sometimes you need to get to your money. Okay, you need to liquidate some of your fund. And you're willing to take the hit, right? So in this case, Chris has an account and he needs $6,000 for some unexpected medical bills, all right? So sometimes you've got to decide which is better, to pay it off or whatever. He decided to sell some of his shares in his Ridgemore Aggressive Growth Fund. When he called the investment company, he was told that the following fees would be charged when he pulls out his B shares. All right, so if he has owned the fund for 21 months and withdraws $6,000 to pay medical bills, what is the amount of the contingent deferred sales load? The word load means a fee, okay? The word load means, what else could it, a charge, a fee or a charge, okay? And so let's think about it. How much is in his account? I don't think, okay, we're just gonna have to assume that we don't know how much is in his account. All we know is he has to withdraw $6,000, okay? So let's put down how much is to be withdrawn. So unfortunately, I don't think they tell us how much his whole fund is worth. So I'm gonna take that out. Okay, I'm gonna take that out because you can't guess about anything. But I do know he's owned the fund for 21 months, right? So I've got this fee put in months. Notice they put it in years. So from 0 to 12 months, if he pulls money out, there's going to be a charge of 5% of however much he pulls out. If the second year and so forth. So if you look and see that 21 months falls in that second year, right? It falls between 13 months and 24 months. Then we can calculate. So it's going to be a 4% fee load or load. All right. And if he makes it past 5 years, there is no more withdraw fee charge. So once again, we've got 6%, or I'm sorry, $6,000. And because of when he's doing it, we're going to look at a deferred sales load of 4%. 4%. All right. So if you take, okay, B31. All right. So this time we'll go here and we're going to take this times 4%. So 4% is going to be charged to his account. So instead of the $6,000, he will only receive $5,760 of the funds. But what they want to know is, what is that load amount? What is 4% of the amount he's withdrawing? Okay, and it turns out to be $240. Okay, so if you don't mind missing $240 from your account to pay off that medical bill, right? Maybe that gives you peace of mind, or maybe you don't want to put it on a credit card or whatever, then it might well be worth it. Okay, but it's just keep in mind that once you start a lot of these investment funds, you can't get to your money just like that. Okay, they have to have notice. They have to sell off your shares. They may charge you a fee. So what's the most important thing you could do, guys, when you start investing? What's the most important thing before you start investing you should have? Do you may remember? An emergency fund. Now, say, well, maybe that $6,000 is more than any emergency fund that you would have ever created. Well, it is what it is. But financial advice is to create an emergency fund of X amount of months of expenses or income. And then maybe you wouldn't have to make a choice like this, but you never know. You never know what's going to happen. Okay, so I think we're ready for number 6 now, which takes us to another one of these problems, I believe. Yeah, another one of these problems, but this problem tells you how much the fee will be, how much the load will be. So this is called a contingent. Something that's contingent means if it happens, right? If it happens, right? So the Dana has purchased a Masterson bond fund. While the fund doesn't charge a front end load, what that means is there was nothing charged to that person when they established it. It does have a contingent deferred sales load of 4% for any withdrawals in the first 5 years. So they don't, their fees do not reduce. Their fee is one amount. It's 4% for any withdrawals in the first 5 years. If she withdraws $14,200, the second year, how much is that contingent load? Okay, so once again, we take 4% of however much she's withdrawing, and the fee becomes $568. Okay, and if she was having it with held from the distribution that she was receiving, she would only get $13,632. So sometimes if the fee is going to be subtracted from your distribution, you have to pull out enough to cover, right? To cover whatever you're wanting to pay for this, pay with these funds. Okay. So, all right. Once again, this is called the contingent deferred sales load. That word load means a fee. Is going to be calculated and charged. All right, number 7. So here is another kind of fee. Sometimes you just have to pay a plain old management fee, like to a fund manager. Julie has current asset value of $110,000 in the account. The management fee for this particular fund, now watch it, it's 0.6% of the asset value. Calculate that management fee that must be paid each year. So let's establish what that fee is. That management fee is 0.60%, not 60%. No, that'd be way too much. 0.06. Okay, okay, and I've got this in here in percentages. All right, so I want, there it is. There's what I want. If you get too big of a number, go back and make sure that you've put in the right percentage, because it should be fairly small compared to the account value. So she's got $110,000, right? And we want that times 0.006. All right, and then 0.006. So we're looking at $660. I can't tell you enough. If you get a bigger number than what you really think would be a fee, recalculate and make sure that you've got your decimal in the right place. Okay. Number 8. All right, another kind of fee. It's just called a 12B1 fee. I took a big test over a lot of this stuff to be able to be a financial advisor. I've lost my license since because I didn't keep it up, but I should have. But anyway, this was one of the test questions that I had to study for. Once again, there's a lot of fees involved, and sometimes there's more fees involved than you understand. And if you don't understand it, you should take it to your financial advisor and say, I want you to tell me about all the fees involved in this account. Okay, because they're supposed to have full disclosure. So if Kathy owns shares in Blackstone Small Cap Fund that have a current value of 29,000, the fund charges an annual 12B1 fee of 0.40%. What's the amount of that 12B1 fee? So just like we did before with the management fee, okay, we're going to put down how much the investment is worth. And this 12B1 fee is 40%. Okay, so let's put the number in. That calculates into decimal form, if you like to use decimals like I do, 0.0040. And that's the number I want to take times the asset value or the account value. Okay, so we want 0.40%. So it's going to be a pretty small number. Okay, pretty small number of 116 is what I got. Come on in, Monty, just a second here. I'm doing a video. You need to talk to me? Okay, I've got a class right now. Okay. So can you come back? Yeah. Okay, Monty, thank you. I just can't, I got to keep rolling. Okay. All right, thank you. Okay, number 9. So a prospectus. A prospectus is usually a great big thick book of all the things about a fund that you could ever want to read, and then some. Okay, so the prospectus for the Colorado Mid Cap Fund, the fee table indicates that the fund has an expense ratio. Okay, an expense ratio of 1.55% that's collected once a year on December 1st. So the Eastmans have shares that value $126,400 on December 1st. All right, so I'm going to put that amount in. 126,400 is the investment on December 1st. What is its value? What is the amount they will pay for expenses this year? Okay, just like, and this is just the expense ratio. Okay, it's right here. If they were to do B1, so this one doesn't even have this. So let me take it out. So they must have changed this problem just a little bit. All right. So their expense ratio, same thing. You just take it times the percentage that you are expecting, right? So let me take this one out. So we're going to take our investment times 0.0155. Okay. So I'm going to change. So the calculation would be 126,400 times 0.015155. Okay, and they want this in 2 decimal places. So this is a fee of $1,959.20. And you may think to yourself, well, 1.55%. Well, big whoopee-doo. Well, the bigger the account size, of course, the more the fee, right? So it's probably being absorbed in the account, which is growing, I would imagine. Okay, so number 9, that is how you, sorry, this is actually number 9. Okay. Okay, the next one is a total dollar return. So we're going to treat mutual funds very similarly to the way we treated stocks. Okay, excuse me. So you can buy and share mutual funds just like you can stocks. All right, so assume that 1 year ago you bought 100 shares of a mutual fund for $44. Okay, from that mutual fund, you're receiving a 60-cent per share capital gain distribution during the past 12 months. And the market value of the fund is now $50 a share. Calculate the total return for this investment if you were to sell it now. You always put your purchase down first, right? So we're purchasing 100 shares at a price of $44. So that is our initial investment. Yep. So let's calculate that. Okay, so we made a purchase of $4,400 for 100 shares. Okay, the gain. Now, the gain, the capital gain, we're not going to know what that is until we put in what we sold it for. So hang on to this piece here a minute. Now we're going to take that capital gain that we're getting. We have 100 shares. They're sending out 60 cents. Okay, 60 cents of a capital gain to us. So we're going to get a check. Or no, it's going to probably stay in the fund. So our fund is going to increase by this capital gain. That is 60 cents by $60. So $60 will be added to our account. And now we're going to pretend if we were to sell this, right? If we were to sell it today, the market price on our pretend sale today is $50 a share. And that's the right direction because we bought it for $44 a share, right? Yep. That's what we'd hoped happened. So the sales amount would be 1,000 times 50, which is $5,000. So if you sold it, you'd have a gain from the sale of your shares of $600 plus the $60 that you got from the capital gains, right? So all in all, the total for that particular year, you just made $660 more for that year. That's the total dollar return. Now I'm going to take this one step further because you may get a problem where you have to do the total dollar return and then the total return as a percentage. So here's how it would work. If you took the total dollar return that you just made and divide by the initial investment of $4,400, you're going to get a return. Okay, so let me calculate that. Okay, we're going to get a return of equals $660, which is the amount we made because we invested $4,400. So 15% is your total percent of total return. This was dollars. If they ask for a percent of total return, you know how to do it. You always divide by the amount of money you invested. Okay. Onward we go. Number 11. Nope, that was number. Oop. Okay, I guess I did number 10 here. All right. That's okay. That's okay. Leave it alone. Let's.
Number 11 is a continuation of number 10.
Okay.
It's what you just.
It's what I just did. Yeah. So thank you, Ada. I had forgotten. So number 10 and 11 go together and we just built on what we just found. So we just found the total dollar return. And now we simply want, so let me just go ahead and plug this in again, because this is a different problem. So one more time, we bought shares of 100 shares at 44 of this mutual fund. Okay, for $44 a piece. And then we sold them, or the value of the sale, even though we didn't really sell them, is 5,000. So the gain on the share value is $600. And then those 100 shares paid out 60 cents per share of capital gains. So that's an extra $60 in the account. So we had a total return of 660. And one more time, to find the percent of total return, you simply divide by the number you invested, always. Okay, what amount of money did it take to get this whole thing started, right? If there would have been any commissions in it, then we would have included it in the purchase price, okay? If we would have had to subtract any commission from the sale, we would have done so, but they didn't tell us about anything like that, so we can't make it up. Okay, number 12. I think we're gonna get out of here early. I forgot that this is a pretty good chapter. All right, we are ready for number 12 now. Total dollar return again. So we're gonna go through this kind of thing again. So we bought shares. We bought 200 shares at a cost of 25. Okay, so let me put this in. And we received an income dividend of 40 cents a share and a capital gain distribution of 80 cents a share during the past 12 months. So instead of just one extra, we have two extra amounts coming in because we own these shares. So we're going to, where am I? Okay. Put this in. All right. We've got to take our number down to 200 because the last time I did this problem, it was 220. So 200 shares for the capital gain. For the capital gain, we're getting 80 cents a share. Okay, I'm going to put this in. 80 cents. 80 cents of capital gains per share. The other one is an income dividend. The income dividend is 40 cents a share. Okay, so 40 cents. So what this means is the capital, there's different investments in the fund, and those investments are making some dividends. All right, so here's that one. Let me check this one. Okay, this is going to be times, oops, hold on. Okay, 200 times 40 cents and 200 times 80 cents. Okay. All right. So here's the extra that came in. Now we're going to pretend to sell it. At the time of the market value is $28 a mutual share on the day that we are doing a mock sale. Okay, so we're going to put 200 shares at a $28 price. And so when we sold them, we're going to take 200 times $28, which is 560. And I got to change something here. Yep. So I got to go back and put in the right amount for how many we purchased. When we purchased it, we paid 25. Okay, so, all right, here's what we got. We got a $600 profit value of the shares themselves. So we've profited or made a gain on the value of the shares. And then because we had the shares, we received capital gains and we received income dividends. So we have a total dollar amount of $840 for the year for these 200 shares of mutual funds. And like I said, you don't necessarily get checks. It just, they deposit that into your account so that your account continues to grow. At least that's the way I would want it. Okay. All right. Now 13, I think, is a continuation of what we just did. Okay. Because now they want to know, well, what's the percent of total return? All right. So I'm basically just going to copy and paste this down there so we can make this happen. Okay, and then these are put in. And we have a total dollar amount of return of 840. Then we simply take that return, 840, divided by the amount we invested, which is $5,000. and we get a percentage. And all right, so then finally we get equals 840 divided by 5,000. Okay, I got 16.80. Okay, where am I getting this number? I'm taking that out. I don't like it. Okay, so it looks to me like if we've got everything correct, we just made an extra $840 and we divide that by 5,000 and we get a return of 16.80. 16.80. So that one is better than the other problem, right? The higher your percent of total return, the better. Okay, the better. You just made more money off of your money. All right, number 14. Okay, now sometimes this happens. Okay, this guy named Mark, he is going to invest every year $4,000. Okay, you're 22, 23, 24, 25. So let me put the years down, and each year he's investing $4,000. So, okay. And each year when he invests that, the mutual fund has a different value. Okay. So let me put 4,000 for each year here. Same amount. Same amount every year, not 40. So total investment, $16,000, right? Let's put that in for the total amount invested over those 4 years. Okay. All right, now let's look at what the price is per share. Okay, so in the year 2022, our price was $21 a share. Okay, 2023, price is 31. Price is 35. And then price is 33. So we got 35 and 33. So the lowest price in those 4 years was $21 a share. So that's when you're going to get the most number of shares. And then the highest price per share was 35. So that's going to be when you get the least amount of shares. Here's the number of shares you're going to get based on that investment amount. The investment amount is the 4,000 every year. So the first one is divided by 21. The second year, the 4,000 is divided by 31. The third year, the investment is divided by 35. Oops. And the third year, the investment amount is divided by 33. So this is the number of shares. All right. So based on that information, you are, when we add up all of these numbers together, we get 555.01 shares. Now you can't sell 0.01 of a share. It's just not possible. And so let's go ahead. Let's go ahead and put in, what did they say? At the end of the 4 years, what's the total number of mutual fund shares purchased? Round your intermediate calculation and answer to 1 decimal place. Well, I think we go backwards to 555. Okay, so I'm going to see what they say here. Could be wrong. And then we're going to take that number. Let me see if I'm right first. Okay, good. Now we're going to find out what the average cost per share is. Okay, so we have to divide our total investment by $555 or 555 shares, which means the average cost is $28.83 a share. And that falls kind of somewhere in the middle, right? of $21 to $35. 28.83 seems a reasonable average. Okay, I also recommend you do the reasonableness test. Reasonableness test. Took me a long time to learn that I should do that just about every time I'm doing a calculation. Okay, last question. Okay. Tanya's retired. She has used income from her investment in the Augur Mid Cap Growth Fund to supplement her other retirement income. During one 3-month period, the fund grew by $840. If she withdraws 60% of the growth, how much will she have? All right, so she's going to withdraw. Okay, so during 1 month period, the fund grew by 840. So she wants to know how much her fund grows every 3 months. And then of that, she plans to withdraw 60% of the growth, So I have to change this to 0.6 and then it should work. So she'll pull out the $504 to help her pay for whatever it is over that 3-month period, right? Because I hate to tell you this, but sometimes retirees have to pull money out before they get dinged for something. If they have quite a bit, maybe they don't want to leave too much for if they pass away or whatever. So the withdrawal amount that she's going to be getting based on the criteria she has set up with the fund is any growth, she's going to take out 60% of it. If there's no growth, she doesn't get anything, right? Okay, that's it, guys. That's all she wrote. So that one wasn't too bad, I don't think. A lot of percentages, right? If you don't learn anything else from this class, hopefully a little percentage work is gonna be in your brain. All right, I am going to stop the meeting. You can go be on your way. All right, so you Zoomers, we're done. Oh, Taylor, I see you're here. Thank you, dear. All right, I will put you down. Let me see who else in case I miss somebody. Okay, very good. Now I have Lizzie and Caden and Bronwyn. So, okay, Taylor, I put you in. We'll see you next Tuesday after Thanksgiving. Have a good one. Yep, have a good one. All right. Do you have a class
No.
coming up? Okay, just a sec. I'm gonna stop my recording and then